why does it matter in society at this point today kind of perspective. I just think in general, like sometimes walk around, I feel like I'm an Atlas Shrugged. Like there's just like such a malaise of like people don't expect shit to work around them in the world, but they also like don't feel like they can go and like fix stuff. Everyone just like goes around and is like sort of like has a low bar for what they expect the world to like provide to them, even like very basic things like internet and energy and like transportation, and nobody just like stacks up and fixes it.
Welcome to High Stakes, the podcast committed to demystifying the institutional adoption of blockchain technology. I'm your host, Alex Nowaka, and today we're elevating the Web3 discourse in a series of conversations with industry iconoclasts that are shaping the future of Web3. Now let's get started. Welcome to High Stakes. I am your host, Alex Nowaka, and today we are joined by Sal Gala, who's one of the co-founders of Escape Velocity, which is a Web3 venture firm. I'll let Sal introduce himself in a moment, but just to give a little bit on his background, he's cut his teeth in traditional finance, somebody after my own heart. I spent some time at Goldman and Financial Institutions Group and investment banking, and then spent some time at the storied venture capital firm in the fintech realm called Ribbit Capital. Sal, welcome to High Stakes.
I'm super glad to be here. I was just checking out some of your past podcast episodes. Arthur had an awesome podcast. I love hearing that guy talk about markets. So very glad to follow in their footsteps.
Yeah, no, absolutely. And we're happy to have you on. So Sal, let's start with a little bit on your background and maybe just give folks who are listening in to High Stakes here that don't know who you are and some of your background, maybe talk a little bit about sort of where you've come from and how you've gotten, here in terms of Escape Velocity.
I run Escape Velocity with my co-founder, Mahesh. We both are former Goldman guys. We sat together in our junior year internship on the 30th floor of 200 West and then worked there together for 2 years. We, for the past couple of years, have been building Escape Velocity into what we frame as sort of like the investor builders of DePIN. We got obsessed with this idea of the intersection of real world use cases and how blockchain enabled businesses could disrupt them and take what were legacy modes around economies of scale and fixed costs and turn them into network effects. And a couple of the early networks were doing this around wireless, around compute. Just got obsessed with the idea, like the massive surface area of what else could be built in this space. And we're meeting a lot of entrepreneurs who just had these like super, super off the wall ideas that nobody else in crypto was thinking about around how to tie these two spaces together. And so we basically set out to create a global community that we ended up creating around this term called DePIN, raised funds to create, help start new DePIN companies and invest in what we felt were the best existing DePIN companies and really invest in building out the global ecosystem. So we've built a lot of analytics platform called DePIN Ninja. We've built a podcast called Proof of Coverage where we interview DePIN founders, a weekly newsletter, an event series, and invite-only conference that we do every year for DePIN founders and investors. And so over the past couple of years, the space has gone from sort of, very disparate, loose ends of like a couple of entrepreneurs around the world with similar ideas into something that has a real ecosystem, has a community around it. Investors understand sort of like if you tell them what DePIN is, or you say this is like a DePIN for X, they understand what that means. And there's a much lower sort of like context barrier for people to wrap their heads around investing and building in the space. And so that's been part of the work that we've been really focused on. It's been awesome to see the community grow and have a lot more interest in it now. So I think the next few years of DePIN will be a lot more challenging, but also a lot more exciting than in the past couple of years. Really feels like we're still in the first or second innings of what the space can become.
Absolutely. And, I would describe you as, really classically institutionally trained, right? When you sort of just look at your background and so forth. And so, maybe give the audience a sense of what you were investing in at Ribbit, and obviously much more of a fintech oriented fund, but, just curious, like what you were primarily focused on there. And then, we can talk a little bit more about, how did that morph into sort of your interest in crypto?
So I guess like to start off, to go back a little bit earlier than Ribbit or even Goldman, like when I was a kid, just obsessed with like building, like I would like buy old computer parts, like put up Ubuntu on them and like spin up whatever like nodes were available back then. Then I was really into SETI. So there was this like network called SETI where you could basically contribute your computing power, send a screensaver, and help basically search for signs of extraterrestrial intelligence in the microwave backgrounds that there was like big telescope in Puerto Rico that's like a mile wide or a couple kilometers wide. And another one, I think in Asia, they would take these signals and sort of like edge compute over them basically on people's computers. This was one of the first distributed computing networks that came around. And so I was into all these like weird internet communities and like running those for SETI. And then that sort of like got me into Bitcoin early, but I was very, very Bitcoin pilled as a teenager as a function of like my family was from Venezuela at the same time as Bitcoin was like becoming sort of like popular online in like 2013, 14, 15. Venezuela was going through these years of like literal 100,000% per year inflation, like some of the worst inflation that we've seen in the past couple of centuries on Earth. And so very quickly, I got very like libertarian pilled on, how do we take power away from government and give it back to these permissionless networks, and money being the prime example of that. When 2017 and 2018 came around, me and Mahesh were working together at Goldman. This is like when the John Pfeffer, I don't know if you've ever read this like institutional take on crypto asset or crypto investors, an institutional investor's take on crypto assets, I think it was called. But John Pfeffer, this old KKR partner, did this like 20-page analysis of ETH and like why he felt it was a bad investment and it was going to be like inflationary in perpetuity, or like wouldn't accrue any value. The velocity of it would be infinite. But that really captivated me and Mahesh's minds when we were at Goldman, and we were like the two kids in the corner, like, at 2 a.m. talking about crypto after we had done our M&A deals or whatever. Actually, the reason I joined Ribbit is because they had a similar piece. It didn't make it as far publicly as John Pfeffer's, but they wrote this piece when they first started buying Bitcoin, the first venture fund in like 2013. It just like was several years ahead of what everyone else was talking about. They saw this integration. They had also done like the early Coinbase rounds. But I was really inspired by how far ahead they saw in the power that Bitcoin could become in 2013, and to just like have the stones to go and put that in an institutional fund at a time when, wallets and custody and like everything was very super nascent. So I joined Ribbit. For those that are familiar, Ribbit is this, multi-stage fintech and crypto focused venture firm. When I got there in 2020, it was 2020 and 2021 were like peak years for fintech mania in all kinds of markets. We went and backed a lot of the institutional players in crypto first, actually, like Chainalysis, Fireblocks, TaxBit, companies like that were like, they were printing SaaS revenues and core infrastructure for crypto. Regular Web2 VCs were looking at them and saying like, hey, the end markets for like blockchain security are tiny. Why would you ever invest in this? Or the end markets for custody today are tiny. Like, why would you invest in this? But if you imagine that many more people would want to get into crypto, and that there was a lot of tooling, like valuable tooling that institutions would want around it, and that there was like a very high trust and safety factor to how institutions would like engage with their vendors, then there was a lot of money to be made investing in these businesses. And they actually became like much larger than what people thought they could be back then, for sure. We at Ribbit had also done a lot of DeFi investing, like Uniswap and Aave, and a lot of like the DeFi champions of the 2020 and 2021 cycle. Throughout this, I got super obsessed with Helium, running some of the early nodes, helping the community out with like governance and grants for a while. We at Ribbit led a deal into Helium and invested heavily into their network. Actually, like a super outsized portion of the DeFi community today, like, shares a similar story. They were like running Helium miners back then, or they were somehow tangentially involved with the network. And so that spawned a lot of the relationships of, people we've known now for several years who are building in the space. But the transition for me, it always came from a deep place of libertarianism. Is always why I thought that crypto was important. And so the transition to DeFi was like, hey, if we have sort of this world computer that people can compute over and share block space, and we have like sound money in the form of Bitcoin, it doesn't really do much in practicality if there's no way for people to access the internet in a permissionless way. And what we saw around the world when like actual dictators or these governments like took over, the first thing they would do is control communications and take over the ISPs. Like, I saw this in Venezuela, we saw it in the Middle East, like in a lot of places. And so this idea of, if we really want crypto to reach sort of like utopia that we somehow imagine it being, you really need to decentralize these other layers of the stack in order to make permissionless access to these other networks feasible. That applies not just to wireless and connectivity, but also to compute. It applies to energy. It applies to logistics and transportation and identity, and a whole lot of other factors. And so that was sort of the, origin of what led me to investing like primarily in the financial grid at Ribbit, to then realizing that, hey, this is also applicable to the electric grid and the transportation grid and a lot of other sort of like infrastructure grids that we see around the world.
Got it. And, I think one of the things that I'm always fascinated by is, as you see some of these, newer categories, right, emerge, venture investors and investors more broadly, right, have to try to figure out how that new space sort of fits in their existing sort of framework or, sort of paradigm in the way they think about the world. When you started underwriting sort of your first crypto investments from like an institutional perspective, how did your thinking evolve relative to, underwriting, let's just call it more of a plain vanilla sort of fintech deal? I mean, you mentioned, hey, there's some businesses that just look like SaaS, right? But then there are sort of unique aspects, right, of every crypto company that make it a crypto company. So just curious what those things were and how you sort of evolved on them sort of in the early days. And then I have another question around some of the specifics of, individual things that you might look at.
Well, it's really hard to generalize. I think ventures, the business of finding exceptions. But I will say, like, one really impactful learning that I had early in crypto, that I think a lot of in the investment community has internalized as well, is like seeing Bitcoin, Coinbase, and Circle. Like, Coinbase and Circle raised like all their early rounds like around similar times in 2013, then 15 and 17. And so a lot of investors that were in crypto at that time looked at these things like in parallel. And the question for both of them was always like, why are we just not investing in Bitcoin directly, or like, can these things really out earn Bitcoin? And I think like when the insight to go do Coinbase or like, Coinbase was a big quote unquote Bitcoin company for a long time. Like that's the original vision, was like an app to help people buy and sell Bitcoin. It actually turned out that like the customer relationships and, security and regulatory, like that Coinbase was building meant that it wasn't just a Bitcoin company. It was actually like a crypto company. Now it's a launch pad and, they have all sorts of different business lines and are able to monetize. I don't have the numbers, but I know it's a minority of their revenues that actually come from Bitcoin today. And so I think you have to think really deeply as an investor in these two spaces as they've been evolving around, like, am I investing in a network? Like, what's the actual moat that I'm investing in? Are you investing in a network effect? And if so, a token is the purest expression of that. And the biggest outcomes have tended to come from networks where you can really cleanly tie the power of a network effect to the economics of the token. That's not to say that there aren't really powerful moats to build other places in crypto, right? That like there are lock-in modes from technology. You can be Metaplex and like build an NFT standard. And like, yeah, there could be hundreds of NFT standards, but it turns out like you're creating a lot of fucking money on your one NFT standard. There's different moats like that. There's customer ownership businesses that can go and like sell like many different products. They sort of like, they may have a token, but it's actually a customer relationship type business. I think you just have to be really clear about what type of moat you're investing in and then like what kind of like instrument you're backing to sort of like express that view, because that's the place where a lot of people have gotten caught on the wrong side or have, invested in something that could have become really special, but ended up sort of like imploding on itself because there was a fundamental mismatch between what part of the cap table or the founders or the customers or like some stakeholder in the network felt was important compared to the real like drivers of the network. Yeah, I think like realizing that we're investing in networks and not companies, I guess, is like the main mentality shift that we've had to have over the past couple of years as we've like balanced investing in these two areas.
And maybe one of the things that, at least from my venture days that, especially the early stage that at least I over-indexed on was really, sort of the founders and sort of the team, right? Execution is really the name of the game. You need to have all those other things you just mentioned, but, really what makes it happen are sort of the people and typically the founders. Have you noticed any differences that, I know you don't want to generalize, but between sort of Web3 and sort of traditional sort of like what's called fintech, founders? Just curious how you would sort of compare those two, if at all.
They're totally different. And I think this was the like 2013 to 2017, like fintech founders, a much different prototype than like the 2018 to 2021 crypto founder. And that's much different than I think that the crypto founders that are finding product market fit today. And I think a lot of people, you always have to be investing ahead of the curve as to like what the next era of like generational founders is going to look like. Because if you were, in 2019 or maybe in 2015, if you met Vitalik, like he didn't look like a fintech entrepreneur. In 2019, you met Hayden, like he didn't look like somebody who was going to build an exchange. And so I think you always have to be thinking ahead as to like what skills are actually going to drive the next layer of value accrual. And the skills you need are much different. Like as a fintech entrepreneur, you had to go be engaging with banks and regulators and sort of like getting these things on your side. As an early crypto entrepreneur, the moats were not built that way. They were built with community or with a really strong technical acumen. I think the stage that we're at now, and Deepen's a bit of a special case because you're tying together like physical hardware component. Oftentimes you're tying together like maybe enterprise customers or like some new type of consumer use case and also trying to implement a token network in addition to all this. The types of founders, you have to be extremely committed to crypto, I think, at a really deep layer because these businesses take more than one like crypto cycle to build realistically. And if not, like people tend to just like hit the exit button if you're not truly committed to what crypto means at some point during that cycle of finding product market fit. The other thing that I think takes, if you're building a deep network or a crypto network broadly, I think like the mental model I always give entrepreneurs is like, it's like running a business naked. Like everyone can see like all your shit pretty much. Like your community is going to have, like, you have to be truly comfortable, people being able to, for things about your finances, about your product development, like building in public, I think it's just a really uncomfortable thing for a lot of Web2 entrepreneurs. And if you don't understand the power that it can bring and sort of like getting the community on your side, then you just see it as this huge like cost and vulnerability and risk to opening yourself up. And so this is a mind shift that we see a lot of founders having to make or making early in their life cycle. Not always something that we won't invest because we don't see it, because people can definitely learn it over time. But it's a common pattern we've seen in most of our successful entrepreneurs.
Let's shift gears to talking a little bit about, starting Escape Velocity, right? You've sort of gone the entrepreneurial path in your own way, right? What inspired you to start Escape Velocity? So we sort of just heard from you about, hey, this is what was going on at Ribbit Capital at the time. So just curious, did you perceive a gap? Was it something, more in a personal desire and a passion to sort of have your own firm? Talk us a little bit through that.
Yeah, it's a really good question. It really came from two factors. One, like a professional necessity is what I call it, which is like there was no firms that were willing to help start early stage Deepen projects. Like we looked around, there were many firms that we felt would put $20 or $25 million into a network that had like hundreds of thousands of customers and scaled and was in Deepen, but there was no capital there for the first million or two. And so there was this like really wide gap for, I guess, to dissect that a bit more, like the nature of it was many of the folks that had made money in crypto in prior cycles, they had done it betting on either communities or like layer ones and technologies, right? And so they had a very prescriptive way of thinking about the world, which sort of meant that like if you were building an app or something that like touched the real world, it was much less coherent to them. It was really, really hard to find funding. So that was like from a professional or like market opportunity what we saw. I think like the real motivation was just a personal necessity to like, we're just like super fucking competitive. And like when you're in a bigger venture firm, it's hard to know when you're winning or losing, right? Like Ribbit, when I joined, was 7 years old or 8 years old. There was almost 10 people on the investment team. Like, you know, by default, you were winning at Ribbit. And I think that a lot of like junior investors at bigger firms will feel that way. By default, as an entrepreneur, like you're losing like every single day, all the time, constantly. I mean, I think that's something that I just like, I couldn't sleep well at night knowing that like I couldn't tell if I was winning or losing or not. And the sign that like I didn't have these like really painful failures for me was a sign that I wasn't pushing hard enough or pushing in like a direction that was congruent with like what I wanted to build. And so we live started EV3. Like, I mean, it was Terra that first, we raised our first fund in between. I literally left my job at Ribbit like 3 or 4 days before Terra depegged. And then we did our first close of our fund like a week before FTX. Like it was a really tough time to be raising and getting people around starting something new in crypto. But ultimately, I definitely scratched that itch for we failed a lot, but also we know what we built over the past few years and helping the DeepIn community has had meaningful impact in terms of like helping founders start companies and building real products for users.
You picked a heck of a time to be, raising your first, venture fund, 2022, not an easy time, just given everything that was going on both in the industry and in macro. What would you attribute your success to being able to raise that fund to? How did you go about sort of soliciting LPs? I think you just did a great job of sort of alluding to this, but VC firms are really products, right? You can think of them as, they have a particular strategy that fit on sort of a bookshelf of, sector stage geography, different focus areas, different types of models. How do you think of, sort of that success, and how did you position Escape Velocity in sort of that general basket of products within the VC landscape?
I really like that framing and I agree with it. I think it's something we didn't realize at the beginning. We learned over the process. I always joke around, we raised like 3 first funds because like during that time, it was like we raised like 15 million and then like, oh, people would leave or like a fund would blow up. And then it was like, oh, we're back at 6. Then like we would get up to 20 and then it was like, oh, something else would happen and FTX blew up and now we're back at 15. And it's like, so I don't think it's something we figured out organically, but just through process of, again, failure and fast learning. The way that I think about the product that we built, though, there were 3 types of people that backed us. There were people who were just betting on me and Mahesh. And it was a relationship. It was like, hey, these 2 guys have high opportunity costs. They've been known each other for 5 years. They're both obsessed with this area that we don't see anyone else like really focused or thinking about. And that historically has tended to pattern match with things that can be really asymmetric and be really big if it works. And so folks that we had worked with in the past closely, like founders I had backed or like investors that we had done deals with in the past, I think fell into that bucket of what they were underwriting was our opportunity cost and our conviction on sort of like what we were doing. Second, like what I would describe more as a product of what we've built is that we went to, again, a lot of the large, like there were maybe 10 crypto VCs that had raised between 100 and 400 or $500 million state funds. They were all investing in the last cycle in like DeFi, NFTs, and consensus layer L1 type stuff. You basically went to them and said like, guys, like you're not all going to be able to invest all of your funds into like the same like 3 or 4 categories. If you give us like $500,000 to basically like flip the card, like we call DeepIn over and see like in 2 or 3 years, we're going to come back to you and we'll have 15 to 20 pre-seed companies that we'll have backed. Some of them will have been successful. They're all going to be in these like fucking huge markets that you can write a massive check into. And for a lot of them, like the math on that absolutely checks out, right? Like if you can write a $500,000 check to flip over an entire new space for you that you might write like several $10 or $20 million checks into, it's just smart, like capital allocation to flip over that card if you think we have a real like chance at discovering something new. And so that was the main product that we were selling. I think that we've been like it's worked. A lot of our companies have ended up being, or LPs have made Series A or Series Seed or Series A investments and things that we did at pre-seed or seed, and they found really compelling. There's also like the allocator class of folks who are more financially return focused. And I think this is something that we learned how to do towards the tail end of the fundraise. But for them, we were basically pitching like, hey, DeepIn today is 3 to 5% of crypto market cap and attention and usage. And like by any sort of like metric, it's low single digits. Fundamentally, if you imagine that DeepIn is going to be this umbrella category that brings like all the real world cash flows into crypto, that's unsustainable. Like it needs to be at least 20, 30, who knows, maybe even a bigger percentage. And so by investing in us, like we're in crypto and we're giving you crypto exposure, but also you're going to get this natural like out earning beta because today we're 3% and tomorrow we're going to be 30% of the broader ecosystem. And so I think for the allocator class, like that was the product that we were pitching them, was sort of like deep and out earning broader, taking share of crypto. And again, all relying on us being like at the forefront of helping to create and invest in the best companies in this space.
And on that last bucket, you call it the allocator class. I would describe it as like the institutional, right, investor, these big either fund of funds or asset allocators like endowments and so forth, right, that make, really long-term decisions around, managers and funds. Was there anything about that engagement that surprised you, either in terms of, these folks were further ahead and more accepting of crypto than you thought they would be, or the opposite? Just curious in that category, what you noticed at the time.
I had actually worked at an endowment beforehand, so I knew some of this, but it really like being on the other side of it, it hit me in a different way. One is that every allocator, like they should own Bitcoin. Like they should just own Bitcoin. Like it's a no-brainer. Like they can own Bitcoin for like 20 bips on fees. And we would meet these allocators who had like 25 fund manager relationships, like paying like 2.5 and 30 and like fees and like all this type of stuff. And it's just like, but they own no Bitcoin. Just like they couldn't get their head around like holding it or custodying it. And if you just do the math on like the fee extraction that the crypto asset management industry has extracted out of like LPs for effectively just paying beta, it's insane. And so I think what I realized is that like there's like one person in each endowment or fund to fund or like allocator, or like maybe two people who realize this. And the issue is that like the way that they express their bullishness is not to go to IC and say like, let's put 10% of the endowment into Bitcoin or even 1%. The way they sort of like express their bullishness is to say like, hey, here's a crypto VC we have a lot of conviction in. It can be a 30-year relationship. We're going to put a small check into it. And over time, they'll get us more into crypto. And that's sort of like the way, the natural institutional type way, because it's so indexed on relationships to go about it. I realized that it's really a career bet. Unless you have these like firms that are already like as a business, sort of like set up as crypto fund of funds, and they're backing a lot of crypto managers like as their day to day. It at the end of the day is finding a champion, someone who's going to make a career type bet on crypto within their institution and already has that institutional trust internally, and finding, giving them the ammo that they need to go and convince their partners. So I think that's the same as like, an entrepreneur pitching a VC. It's the same as the VCs pitching endowments, but just seeing it consistently over and over again play out made me realize that like, okay, everybody knows that like a lot of this is beta, yet the institutional imperatives make it so that you're still pitching the relationship in order to like get connected to these folks.
The classic alpha versus beta and the confusion around it sometimes by some folks, both investors and then allocators alike. Sort of last question for you on sort of the venture fund landscape, because I think you just know it super well because you're in it. How would you sort of describe the landscape today from a crypto fund perspective? Like my sort of take on this is you really have three categories. You have, really large platforms that have dedicated sleeves to crypto. So I would throw like, A16Z crypto, Faction, which is Lightspeed's kind of crypto sleeve. You've got sort of a second category, which is, I call it, crypto's kind of shoehorned into like an existing strategy, whether it's fintech or what have you. And that's effectively what, General Catalyst has done, Sequoia's sort of done. And then you have like this whole category, right, of which you're in, which is like crypto native funds, right? Whether it's, Escape Velocity, Paradigm, Multicoin, right? List time goes on. How do you see sort of your, let's call it competitive set, or just sort of generally speaking, the sort of crypto specific fund universe? Is it sort of thinking about it that way, or do you think about it differently?
I think about it slightly differently, actually. I think that venture as a whole, notwithstanding crypto or not, like you need to take money in, invest in good companies, and like return money out at the end of the day. I think what people are missing is that the entire like last generations of investors took liquidity for granted. Like there just weren't that many IPOs, there weren't that many stocks. And so like if you had an IPO or stock, like you assume that there was liquidity in it. And we've seen across like, I think every single market, this shift towards investors who natively understand that like liquidity is not there, or it's not there when you need it. And you actually have to like work for it or track it or pay for it, or like understand like the liquidity dynamics of whatever you're investing in. And so in the like, public markets, you see like, whatever, like Cliff Asness or whatever, complaining that like the indexes like are, they're not buying his like good companies because like nobody's out looking for like the real underperformers, or everyone's just like passive flows. And so you don't get this like real price discovery or liquidity in names. I think this is happening now in venture, whereby like M&A markets are pretty much closed, that like nobody is going to pay, or like both because of regulatory pressures, like the landscape for really big acquisitions has just like become much, much harder. And IPO markets are even worse. And these two things compound on each other, because like if acquirers know that you can't IPO, then they're less willing to pay big prices for acquisitions. And it sort of becomes this downward spiral whereby like actually the exit paths for venture, like it's just like, it's a one-way door. Like people put money in, but they're not going to be able to take money out. And so when I think about what the venture landscape truly is today, it's like there are firms that can create their own liquidity. I put platforms in that aspect. Like they can have these continuation vehicles, or they have like General Catalyst as a private equity fund, or like maybe they have public hedge fund structure, but firms that can create their own liquidity for their best performing companies. Like that's one category. And I think crypto native investors who like understand the crypto market structure and are able to like structure networks and like get a token to millions of people and billions of market cap. Like that is another way that you can help influence and structure your liquidity events. And so like those two things, I understand why, like these are the winners, in my opinion, of the future of the venture landscape. The losers are like the Web2 VCs who are investing in like SaaS and marketplaces. Like, I'm sorry, but that has zero bit. Like your portfolio just has zero bit. Like you should just go do something else. Early stage VCs who are doing like hardware and enterprise things, I think are in a really tough spot because businesses need a lot of capital. Again, like it all compounds on the fact that the IPO markets are closed, which means that M&A comps are now much lower, which means that like all your late stage rounds also are anchoring towards lower valuations. And so I think like no matter what price you pay at early, there's no price cheap enough basically to like invest in a capital intensive business at early stage where you're not going to get diluted 90% or 95% or like maybe even more. So I think those VCs also will find it really tough. And I think even within the crypto native firms, like the people that only follow into rounds and sort of like aren't actually able to meaningfully help companies get to a positive outcome in terms of like launching a network and getting liquidity in their token, I think are going to really struggle. So it's more about like, have you built the skills or the capabilities to go and ensure that your best companies are able to like access the capital markets in perpetuity and get liquidity? Like for me, that's what's going to decide the winners and the losers of the next 5-10 years of venture.
Really awesome. Maybe switching gears now and talking DePIN, which is, obviously where you guys spend all your time, and also, maybe even plug you here in terms of, just what you've been able to sort of add in terms of capabilities at Escape Velocity, right? You guys have, research, analytics, like building, maybe just give the audience sort of a sense of, why DePIN, right? I think you alluded to this earlier in the conversation, but it's, the focus is obviously, for you very, very clear. And so how do you see like the broader thematic, right, of DePIN? Like it's clearly for you resonating at multiple levels, and you just see that that's where a lot of value is going to accrue. And so maybe just what are the underpinnings of that?
What it really comes down to is that DePIN is about empowering and incentivizing people to improve public infrastructure. Like I think that's the umbrella definition of why all this stuff matters. From like, why does it matter in society at this point today kind of perspective? I just think in general, like sometimes walk around, I feel like I'm an Atlas Shrugged. Like there's just like such a malaise of like, people don't expect shit to work around them in the world, but they also like don't feel like they can go and like fix stuff. Everyone just like goes around and is like sort of like has a low bar for what they expect the world to like provide to them, even like very basic things like internet and energy and like transportation, and nobody just like stacks up and fixes it. And I think like DePIN is this transition where you start to get into people's minds like, hey, you can actually get paid for changing things or for contributing, or maybe it's something you're already doing and that value is getting extracted from you today. You get it like disintermediating the middleman and giving that value directly back to you. And you can reinvest that into making the infrastructure even better for other people. And so anything that is a traditional infrastructure network that requires a lot of like fixed costs or labor costs, like a big upfront capital or labor outlay, I think what DePIN does is like allow you to protocolize that and turn it into like micro contributions and break it down. And so now anyone can make a micro contribution to your network. When you zoom out and look at it from a 10,000 foot view, what previously looked before like, a telco business with a bunch of fixed assets that you need to like lever up with debt, and is like, you have a very, very tight range for like what can happen without the whole thing sort of like blowing up somewhere, like, or equity holders blowing up. You now have this like very flexible network that has micro contributions that if somebody helps, and it's only worth 5 cents, you can pay them a 5-cent payout for doing that, or like whatever it is. And so you naturally have this thing that's much more dynamic and adaptable to the conditions of business and overall has better economics. And that applies to somebody that in the telecom space to deploying antennas and like Wi-Fi routers. It applies in energy to like deploying solar panels and batteries. It applies to mapping and general like sensors to just like, going and deploying or taking images out of cameras. And all of these networks we think will eventually, like if you can have a global talent pool that's empowered to build something together, that fundamentally is always going to be a centralized and sort of like incentive misaligned entity that's trying to do it from the top down.
Yeah, I mean, I think you ad lib a little bit on that. It's bootstrapping infrastructure in a new way using like completely new incentive models, right? And, that your point to, micro versus macro here, it's obviously where, that dynamic is shifting overall. Sal, when you think about 10-year sort of horizon and DePIN is, wildly successful, what does that world look like? Like what's a futuristic kind of like use case or sort of consumer user experience that you just think is like unfathomable today, but like in 10 years if DePIN is successful, it's sort of common?
It's a really good question. On a 1 or 2 year time frame, what I'd say is like there are these like really antiquated things. Like imagine an entrepreneur was telling me about this use case today around like when you lose your dog, like what's the actual, like how hard of a coordination problem is it for humans, like for our society to like place a lost dog with its owner again? Today, like your kid has to like go around and like staple papers to like every pole in the city and like hope somebody calls and they're super sad and maybe it takes multiple weeks. In the 21st century, is that really like the pinnacle of like human collaboration that we have? It's like, no, you can imagine DePIN solving this like tomorrow. And so I think there's a lot of like, if you extrapolate that 5 years forward into much harder coordination problems, like, powering like cities or like there's many, many issues that I think it's hard to say like, how does it look in 10 years? But if you just imagine like what DePIN can do for small coordination problems, then it helps you imagine what it can do for really large coordination problems. I will say though, like I do think DePIN is we're like very early in phase 1, but there's going to be these 2 phases. One is like independent DePINs. We're maybe in the middle of it now where the DePIN products that are working sort of like on their own. There's not a lot of composability or interoperability with networks. I think like we're going to see this like second phase of DePIN, which is going to like really drive productivity, which is basically composability and interoperability. By that, I mean like driving home at night and maybe my like battery at my house starts to deplete my power levels because my electric car charger is going to get there. And when it gets there, like there's these like power optimizations that it can do. And at my office automatically like queries the state of like the Helium block or the wireless blockchain. And it knows that I'm traveling in this place and now I can like decrease my energy usage that's going to the office. And so once you have these like dynamically adjusting, if you imagine like the Helium wireless network can tap into like cameras taken by HiveMapper, or it can tap into compute from these decentralized compute networks and sort of like dynamically adjust itself to the realities of the world. That's when you start to get real efficiencies, right? Like if you have a 20% efficiency in the wireless network and a 20% efficiency in the compute infrastructure and 20% efficiency in energy, and you compound these together, now all of a sudden you're like 50 or 60 or 70% better than what a traditional infrastructure stack can enable. And we saw this with DeFi. It just happened much faster because it was all software based. I remember like Alchemix, like self-repaying loans were like the first thing in 2020 that came out and was like, composability for on-chain. And now we have these entire like super complex interconnected ecosystems of DeFi products. I think we're going to see the same thing happen with DePIN, just we're a little bit earlier and the time frame will be a little bit longer, but we're going to see like really cool stuff that wouldn't be possible otherwise. That's only possible because you have these DePIN networks interacting with each other.
I'm curious to hear your thoughts on this. That I was always heard the phrase in sort of like, VC circles that hardware is really hard, right? And so it's why you see so few hardware focused VCs is that, to your point, like the CapEx is super high. Businesses typically need a ton of capital. And then there's also I will call it like the technological risk. Like, is it going to work? Right, ultimately. Do you see DePIN as a way of de-risking sort of that component, or is it more complex than that? Meaning, when I look at Helium as an example, there is a hardware component, right? So the physical component here is you have these sort of router devices that, need to be produced. They need to get, distributed, this, that, and the other. That might be a unique case or a unique model, but sort of how do you see the physical, like hardware component relative to, DePIN as a category?
I think what DePIN solves is the coordination issue. And because of that, the networks that we've seen work the best are actually using commodity, like they tap into existing ecosystems of hardware or like firmware type of things. So, Wi-Fi is like one of the most well-developed supply chains. Like, I don't know, there's probably like tens or hundreds of millions of Wi-Fi routers that get produced every year. And so actually, like, I think what Helium and others found was like, they tried to do this like technical innovation with CBRS originally and like some more complex like wireless standards effectively try to offload onto carriers. That ended up like not really working. What worked was like taking the very simplest technology, Wi-Fi routers that like everyone uses and already like sort of like agreed on these like global standards, and solving the coordination issue using this technology that already works. And I think we'll see similar things for, in energy, like solar panels, like work and they're cheap. And there's this like massive global industry capable of producing them at huge scale. And they've never really been able to find their true potential because there's all these coordination issues within the solar supply chain across like financing or like the incentives of like getting someone to install it and be responsible for it or take risk if it doesn't last for 20 years, like XYZ. And what crypto can do is take the solar panels that already work and actually like unlock them basically and create these like huge global networks of it. What DePIN is uniquely capable of solving is stuff around the hardware, not necessarily the hardware development. I agree that like it's harder and you have to, I wouldn't say it's necessarily harder, but you have less shots on goal, right? Like if you raise a seed round for a hardware company, like you better get the first thing right, or like maybe you get like half a second shot. It's like, it's not gonna be like software where you get like 10 different tries to do something if you're scrappy. It's just not. And so I think you have to be a lot more methodical and thoughtful around like how you outlay resources. But I will say from a product perspective, like there's this Alan Kay quote, like people who are serious about building software will build their own hardware. Like there are experiences that to build something that feels truly magical to users, you have to have really in-depth control over both the hardware and the software in order to enable that. This is like, the Vision Pros for, or like AR, VR things. Like it'd be very hard to build that if you didn't have really fine-grained control over the hardware, right? And so I do think we will see like the most special products built using a combination of those two. One last thing is that I actually think this hardware is hard thing is more of a boomer thing. Like I put myself in this category as well. But like when we go to like college campuses and go, like those kids don't give a fuck. Like they're just like, they're using AI generated CAD things. Like they're printing stuff on 3D printers. Like for them, like it's not that much harder. They're just already using tools way more nimbly. I think everyone in our generation is, and finding ways to make it happen.
Just going to note that you lumped me and you into the boomers for just a second there, just calling that out. So Sal, you obviously look at a lot of DePIN projects, and I'm curious when you sort of mental model and framework for thinking about, what signals breakout potential or high potential when you see, a new DePIN project. What are I'll call it like fundamentals you sort of look at and say, hey, this one could be potentially a screamer. We need to pay attention.
I agree with what you said earlier about it all being about founders, but I think that's not like a very actionable advice. So more in terms of like fundamentals or the idea, what do we look for? One is really big markets. I think we differ from other investors in this sense, but my view has always been like, hey, if we have shots on goal to take with wireless, which is almost $2 trillion of revenue globally, or energy, which is like $2 trillion, or cloud compute, which is like, going maybe now like $1 trillion of revenues globally. That's where we should really focus our bullets, because a single win there can generate extremely asymmetric returns. And that's sort of like what we get paid to do, is find the best ideas and the highest returning ones. There are markets that are really good for DePIN, but not good for venture capitalists, right? Like there are a lot of like hobbyist networks that I think will get built in a DePIN way and people will get a lot of value out of them, but I don't think are necessarily like big enough to underwrite a venture scale outcome. And so, if it's like a network, like ham radios, there's like maybe like, I don't know, a couple thousand like ham radio enthusiasts in the world. Like if you were going to build like a ham radio DePIN, like that would be sick. I would love it. But I don't think that's like a venture backable thing. And probably the right for it to exist is in some sort of like DePIN network that is just like not very highly valued realistically. Anyways, what we look for is like one really big market. So if you're using DePIN in a way that allows you to like break into a market that's $1 trillion globally, that's really, really exciting to us. We get really excited about DePINs that enable new cohorts of businesses. So originally, I think a lot of like the initial excitement around DePIN was like, hey, if we build this like resource that's 90% cheaper, whether it's bandwidth or compute, and we go and offer it to enterprises, they will come and like switch their existing infrastructure to us. And now, like, I unironically don't think 90% is good enough. Like, an enterprise will not switch to you if you are 90% cheaper on their core resources. There's so much like things that they've built around it and sort of like integration issues that it's just not worth it for them, or like there's nobody well placed within the organization to make that kind of bet. And so we've gotten way more excited about DePINs that you can imagine really new forms of businesses being built on top of them that couldn't exist before. One of my favorite examples is like, I have this friend who I went to college with who went and started he worked at a private equity firm for a few years. And there's this industry of like, called dialing for dollars. Basically, like if you have like a home that's like foreclosed on, you can like basically monetize that lead because a bank will go and like inspect it and see if they can buy it at a discount. And so he was rolling up a couple of these companies at his private equity firm. I told him about I buy all my friends like DePIN stuff. So I bought him a Hivemapper, he put it on his car. And all of a sudden he started like using Hivemapper to like track, like basically like get people to scan neighborhoods where he thought were high probability of having these like leads that were going to be, or homes that could potentially be foreclosed on. And then he would sell that to private equity firms. It was super scalable. And like, in 2 months, he just quit his job and now he just like does this full time and plays pickleball like 6 hours a day. He lives an awesome life. The ability in the case of mapping, the ability to have eyeballs basically anywhere in the world, like on demand way, is a super, super powerful primitive that a lot of other businesses can be built on top of. And so, yeah, we always try to imagine like what other entrepreneurs are going to use your network and be able to build cool new stuff on top of it. If we think there's a lot of use cases that are very, very valuable that can use that for something new, it's something we react really strongly to.
Curious if you see big potential in terms of market. I know it's early as it relates to AI and the intersectionality with DePIN. So I'm thinking like BitTensor as an example. Do you think it's just too early? What's your sense of that?
Wireless, compute, energy, and mapping are like the ingredients to AI, right? Like you need bandwidth, you need compute, you need energy, and you need some like data. And you put all these together and like DePIN you can be like about the inputs to these things and you're like buying the underlying digital commodity that you need to create intelligence. Or you can go on the other edge, something like BitTensor, and invest in the outputs, which is sort of like this network that is trying to incentivize intelligence, useful intelligence directly. And so I think we actually see these things on a continuum. It's just like, are you investing in like the pre-production of intelligence phase or the post-production phase? Like, where are you directing your incentives to? But we view it all as one sort of big category. And it's inevitable on a long enough time frame horizon that like the main consumers of like Helium bandwidth and like render compute aren't going to be humans, but it's going to be AIs. And so these are naturally going to become like way more interconnected over time.
And I always like to ask the question where folks, source, their opportunities from. Are you typically, outbound, inbound, like through your network? Are you attending conferences? Not every conference that you go to in the crypto space necessarily has like a sizable DePIN component as an example. You've also launched your own sort of conference. Just curious, like how you source and how you think about that, because it's obviously an important component in sort of the life cycle or the value chain, right, of what you do.
Really just tried to always add value to the DePIN community, and like good things have come of that over time. We found, and rather than trying to be too prescriptive about it, like what we have done through our like technology stack, we're big believers in lowering latency basically. And so I had this mission at the beginning of this year. I was like, when a new DePIN is formed, like we need to find out about it faster than anybody else. Like, how do we enable that? And so what we created was this like sourcing network that is basically decentralized, but we put pool of USDC on Base. We put like $20,000 in or $10,000 in or something. We created some very rudimentary contracts. So like we have this database of DePIN projects and create forums so people can easily like submit things to it if they have a new project that we're not tracking. Built some like rudimentary pipelines around having AI initially like validate the data and then having manual people like make sure that it's actually correct on our side. Once that goes through, usually within like 24 hours, people can go and claim $20 from like this like on-chain pool of rewards. And so we started doing this with a couple of our friends. Now it's like we have like 50, 100 different people who like every day send us like 50 different DePIN companies, and they sort of like go through their pipeline to get verified, to get validated, the data gets enriched. And then if it was successful, those people get rewarded. I really like this system because it empowers us. We always thought of EV3 as we were initially wanted to launch as a DAO actually, but it was going to be like, we need to have investment decisions be highly centralized and everything else about the firm be highly decentralized. And so the way you decentralize sourcing is to have these micro contributions to our database of like new DePIN projects. And so what we have now is like, we don't have to go to crypto conferences anymore. We have these people that like, they just go, they walk around the events, like every single like logo they see on a t-shirt or name tag, they submit it to our database and like they pay for their like tickets to the conference that way. We never have to like, there's zero admin burden associated with it outside of the technology we've already built. So yeah, it's been from introductions and people like us just like trying to help folks in the DePIN community, but we've also tried to build these little mousetraps around how do we actually become a DePIN ourselves and incentivize people to make these micro contributions to our firm.
So penultimate question here. How does participation differ between sort of a traditional network and sort of a DePIN network? Maybe give you a little bit of a lead in here. Are there any sort of networks that are more ripe for DePIN? So, I look out there and I see Solana's made a big play in sort of the meme, sort of coin space, and it has been expanded rapidly, right? You've seen Ethereum sort of go more of more institutional folks are much more focused on sort of Ethereum. So I'm just curious how you see the differences and or the similarities, frankly, between those networks. And are there any networks that are out there that are more ripe or not for sort of DePIN activity?
There's DePINs on every chain, or I'd say, that there are a lot of DePINs on Solana. There are DePINs on other chains as well. So I think we've seen a fairly like diverse cross-chain ecosystem emerge in terms of what the more you can tap into, like the more you can push out the power of the network truly to the edge, the more powerful it is. I think you get into trouble where you're either highly centralized or your customers are, again, like lowering costs for enterprises, I think is just not that great of a use case. I think enabling new revenue or enabling new products for enterprises or for consumers is a much stronger value proposition. So in general, I think, places where the hardware or like the technology works, but the coordination issues are what like breaks the traditional models, right? Like in the MVNO, or in the cell phone plan, it's like that stuff all works. You can go and use cell phone plans from like 30 different people, but none of the businesses have survived because they pay these massive rents to the big telcos because they can't coordinate a network deployment on their own. So these are some of the signals that we see, I think makes an area like more ripe for disruption than some of the others.
Yeah. And it sounds like, what you're also saying as a read through is that, there are some of the big enterprise players in the infrastructure space will be disrupted. There are also, some enterprises that could leverage the technology, but in so many different ways, there's varying degrees and layers of like how they get there. And in some ways, your point is, hey, going consumer in a lot of ways is like not only a bigger market, but it also is more of a real term, near term opportunity for, a lot of these networks.
Yeah, partially that. Or I think like you need another layer to go enterprise effectively. Like we see a lot of compelling businesses go selling to AI companies who then effectively use like their data they collected to then serve enterprises. So there's a couple like police departments that were trying to use like drones for speed cameras, basically. The issue was that then they were getting contested in courts, and the office, like there was no court method by which the drone you could verify that the drone was actually like took a picture of that place at that location that worked from a legal perspective. And so some of these companies are now using DeepIn networks to basically like geotag, like, hey, I was like within, this many meters of like this tower. And then that means that now this becomes like sort of like sanctioned from a government perspective, and we can use this in court and buy tickets from it. So in that case, like the enterprise is like a police department, not very tech forward at all. It's buying technology and paying a lot of money for this AI company who is then actually using the core resources provided by AI. So I think it's like you need a layer of service in between that I think some companies are really well positioned to do. But a core DeepIn itself is very hard for enterprises to like interact directly with without having, this like service or value.
Yeah, service or a coordination layer. So Sal, we asked all of our guests on High Stakes for their hot take. What's your hot take, biggest, boldest prediction for Web3 ecosystem in the next 12 months? What do you got?
I've been saying this for a couple of years, but it feels like we're really close now. I think we see a country, we see acceptance of a country with like geopolitical power behind a country that like actually identifies itself as being crypto first. And not just like, some random island that's like doing ID stuff, but like actually like recognize some sort of like recognized power by a country that either is giving up monetary sovereignty to like using Bitcoin, or they're giving up like sovereignty over some type of infrastructure. Maybe they have some like DeepIn powered cloud network or telecom, but I think this is something that happens in the next 12, 18 months. And, behind the scenes, there's a couple of like sovereigns who are actually really leaning really hard into making this kind of stuff happen.
Super exciting. Well, that's it for this episode. Sal Galla from Escape Velocity. Sal, thanks for coming on. Looking forward to having you on again soon.
Thanks, Alex. This was awesome. Enjoyed it.
Keep exploring and keep innovating. Learn more at validationcloud.io and follow us on X and LinkedIn to stay connected as we continue to shape Web3 for institutions. This is High Stakes with Alex Nwaka, signing off.